welcome to the podcast, everybody. Thank you for joining me. Well, the markets are still open. We got about an hour to go before the close, and I just wanted to get an update to you and let you know what's going on with the overall market. It's been a while since we've done a podcast, and really things are starting to pick up a little bit on the volatility side. Of course, we had that streak of 1% or lack of 1% down or up days, and then we had the Malaysian Airlines being struck down, and that was this day right here. So we had two 1% moves in one day, or excuse me, 2 consecutive days. We hadn't had that in quite a while. But overall, if you kind of zoom out here, you still see that we're not getting the type of volatility we had, back over here, even back in early April. And we are seeing some deterioration. One of the main things I wanted to point out to you today was the move that we're seeing in emerging markets. They are making new highs even as we sit here with about an hour to go in trading. The S&P's flat on the day. The Dow Jones is flat on the day. The Russell 2000 down 0.4%, which we'll get to that in a minute, yet emerging markets are up 0.6%. So quite a bit of outperformance, and that continues. And, it's a little surprising. You would have thought, given everything going on overseas, that emerging markets would be struggling. But you're starting to see a breakout in China, and that's helping not only China, Mexico, which is one of our favorite areas, doing well. So we own emerging markets and we own Mexico. If you take a look at FXI, for example, this is the China 25 ETF, the FTSE Shanghai, Xinhua China 25 Index ETF FXI. And you'll notice here that if we kind of zoom out, it's starting to break out. And if I were to go back a little further, you would notice there was another breakout longer term. And so this last couple days is getting everybody's attention because we are starting to see this breakout. Today, up 1.74%. And, so that's getting the attention of a lot of people. And when you combine that with some of the other emerging markets that are doing well, it's no shock that EEM, which is the emerging markets ETF that most people look at, it's also breaking out to new highs. So watch that, because remember, what happens with the emerging markets is they have been underperforming for a long time. And because they were underperforming, you started to see them become more of a value. And a lot of people don't equate emerging markets to value, but they have become a value if you look at them compared to America. Number one, they have a higher dividend yield. They have faster growth rate, and they have a cheaper PE. So we may be seeing the beginnings of people shifting from the S&P 500, perhaps moving into emerging markets. So watch that, because, again, as this stock market matures, you're going to see rotation. Doesn't mean money's going to come out of the market, but it'll move to different spots. And one of the spots that we're seeing it move into is the emerging markets, which we do like. And so, again, as you see here, kind of breaking out in the last few months. So watch that, because all of 13 emerging markets underperformed while the S&P was going up. So you really saw a big divergence. Now you're seeing money move in there, probably playing catch up to some degree. Now, if we move over, let's look at the Russell 2000. This is an area of concern for us. Now, these three spots that I've got arrows on, these were bottoms. We actually bought the Russell 2000 back in here for a quick trade. We may be heading back down there again, because the Russell 2000 has been underperforming. It started to outperform in June, but now we're starting to see it underperform. So it looks like we could be heading back down here. If this area, 1085 or so, is broken, watch for not only the Russell to underperform, but watch the overall stock market break down. And there, a lot has been made about if small caps are underperforming, there's doom and gloom for the rest of the market. That's not necessarily the case. You go back and do the research. We've actually looked at it just as many times. The Russell's underperformed, stock market's done fine. But it is a warning sign. It is something we're watching. And, we don't own the Russell right now, but because it's underperformance. So we're tried to shift some of our assets into the larger cap names if you're going to stay in the stock market. And right now, there's no reason to not be in the market. But look at what's going on underneath the surface. Emerging markets are working. Russell 2000 is not working. And if that continues, watch the longer-term trends, because you start looking at all these moving averages. Could they start to roll over? Remember, they were outperforming. Everything was looking pretty good. Then we've spent 2014 kind of moving sideways above the plus and minus zero line. And now if we start to see these moving averages roll over, that could signal trouble for the markets down the road. So watch that. Those are the two main things that I want to point out. If you take a look at gold, gold is not an easy chart to trade for sure, and but gold did work on Friday when the markets were selling off, and so we've seen the market sell off, and those days the gold miners doing very well. You've also been watching interest rates, kind of trying to scrape the bottom here. If you kind of look back at this is the 10-year Treasury rates. So we've been kind of stuck in between 2.5 and 3, and we're now at the 2.5 range. So if you think we're going into a recession, you want to buy Treasuries because you think rates are falling. If you think that the Fed is going to taper, obviously finish tapering and not do any more QE, and you think they're going to start raising rates next year, perhaps you think that this is going to happen. So, but overall, just balance this out, right? Because you have some assets that do well when interest rates fall, and you need some assets that do well when interest rates rise. And if you balance that out, then you'll be looking pretty good. Today we did sell our holding in Micron, which had been doing fabulous, but Micron is showing some weakness today and looks to us like it might be rolling over. So we had about a 25% gain in our aggressive strategy. Went ahead and locked that in and are moving on to something else. So again, in this environment, for your longer term things, just look for the rotation, right? Moving from the different asset classes around. Right now we're seeing money flowing out of small caps into emerging markets, and S&P is kind of neutral a little bit. But also watch some of these stocks, because in your trading portfolio that you're doing or your short-term trades, look to take profits, rotate into the stronger things, because as the markets mature, that's what's going to continue to happen is stocks will start breaking down one by one. And this stock is still cheap. It's a great company, but again, starts to look like it's rolling over a little bit to us, so that's one we've exited. But going back to the S&P real quick, you see how tight this is. Nothing worrisome here, but we do have potential for it to fall, especially if we're starting to see some of these other things break down. We could see at least it touched that. Also, I've been mentioning on Twitter, watch the junk bonds. Junk bonds are underperforming, and as junk bonds underperform, sometimes it's a precursor to the stock market. So you can see that they were in this nice uptrend for the last several months, and that's kind of been broken, and now we're getting this. So if they break the 200-day moving average, you'll hear more about that. And you're starting to see treasuries outperform junk. So just that risk off is starting to happen a little bit, but it's not full-blown where the whole Dow and S&P are falling. It's just something to watch. So keep an eye on these things, but definitely there's underperformance going on with the Russell, and there's outperformance with emerging markets, and there's underperformance with junk bonds, outperformance with treasury bonds so far. Hey, just a reminder, we are coming to Houston August 14th. For the investor CrossFit session, we're calling it. We're going to touch on a lot of different topics, and we were asked basically to do a speech there on the markets to a small group of people, and we decided, let's just open it up to the public. So we're doing it for anybody who wants to come. There is obviously the seats are limited to a certain extent. We can't have 300 people in this room, but we are getting people signing up. So if you want to come to that, it's free. It's August 14th, giving you plenty of notice from 7 to 9 at the Houston City Club, but you have to RSVP for that because the space is limited, like I said, and you have to have a reservation. So if you go on the website, it's the first thing you see. You click on it, and you'll see not only what we'll cover, but as you scroll down here, you'll be able to fill out and sign up for it online right there, or you can call the toll-free number right here, and we'll get you signed up. So lots of people have already signed up for that, and we'll be coming. If we may be doing it in other cities, but for right now, Houston is where we will be doing it. So August 14th, give you plenty of time. It's the Investor CrossFit session. Hey, thanks for joining me. Appreciate it. Hey, don't forget, eggerscapital.com is the website, not only to sign up for the Investor CrossFit, but to get more information, email alerts, and so forth. And twitter.com/Karl Eggers. You can follow us throughout the day on there. We're on Facebook. We do our weekly radio show. So lots of ways to get a lot of information for you. All right, have a great day. We will talk to you soon.